So a common goal for a lot of clients is that once they have built up enough equity on their investments is that they try to freehold their own occupied. It makes a lot of sense because now your investment property has enough equity, you can shift all your mortgages onto it, and now you have a own home that is mortgage free. But should you do it? Is that the best structure? What's going on, everybody? It's Blandon here from Mortgage HQ, and in this video I'm going to share 3 arguments to why you shouldn't freehold your own occupied just because you can. The first reason is because the own occupied home is the last property that you want to sell. What do I mean by this? Imagine that you have built up enough equity on your investment portfolio. You decide to go to the bank and said, hey look, I'm going to shift all of the mortgage on the investment properties. You're going to then discharge your own occupied. Now you have a mortgage free home and all your investment properties are now sitting at the bank with a mortgage on it. But suddenly a family member have a critical illness and you need $300,000 for private treatment. Bank policies change. Now you can't get the lending that you could before. And if you decided to sell one of your investment properties, the bank is demanding that you repay all of the sales proceeds. So you're left with very, very little cash and not enough for the private surgery, virtually leaving you with no benefit for selling because now you have no leverage on an asset that was cash flow neutral. So now you're left with 2 choices. 1, sell your own occupied home, or 2, finance your own occupied at a second tier lender at a very high interest rate. You'll only be able to get that loan for short term, so you still have to sell some investments to pay that loan off later. Both scenarios are not ideal because when you want cash quickly, you're more likely wanting to sell your investments and not your own occupied home. And by securing all of your investments with the bank and then freeing your own occupied only, you have a lot less liquid assets that you can just sell when you have an emergency. This is one argument towards why you would put your debt on your own occupied instead and freehold the property that you would potentially sell in the case of a financial emergency. Secondly, the own occupied is an asset that has a very low return. What do I mean by this? The one major advantage with investing in properties is that you can use leverage. In other words, you can use the bank's money to put it in an asset that's going to give you some cash flow and give you a long-term return. Without leverage, there are actually a lot of alternative investments that you can put your money into where you'll get more cash flow, more capital gains, and probably less headaches in terms of managing it. This could be commercial properties, shares, managed funds, or even a business that you can buy into as a silent partner. A freehold owner occupied not only will give you no leverage, and most cases won't give you any cash flow at all. So you're basically in the situation where you have a lot of your capital locked into an asset that is giving you poor returns. So what should you be doing instead? Well, you could potentially borrow against the own occupied home and put that money into an investment that has cash flow to pay for the mortgage itself, such as a cash flow investment property like a multi-unit where the rental will cover all of its expenses. Now, if you want to look at what a cash flow positive property look like in this current environment, check out one of the videos in the description below. If you do it this way, you are not only just getting the capital gains on your own occupied, now you're getting capital gains on the second property that you buy, and you don't have to put any more of your own cash into it and won't cost you anything extra at all. Now, the third reason of why we don't recommend that you freehold your own occupied is that you can borrow a lot more from your own occupied property. Investment property, you can borrow up to 60%, meaning you have to leave 40% deposit or equity in there. With an owner occupied, you only need to leave 20%, so you can borrow up to 80%. With this 20% extra equity, you will be able to borrow a lot more from the bank because you can just use that as a deposit, and that will allow you to get a lot more leverage out of the bank. Not only that, an owner occupied usually have a much higher value than your investment properties, meaning you might not need to give 3 properties to the bank and maybe just give 1. So a typical scenario Just to give you an example, clients might come to us with a $2 million owner-occupied home and 3 investment properties that are around $800,000 each. Now, if they were to shift all their mortgage to all of the investment properties, they would have to give up 3 investment properties. Whereas if they just shifted the mortgage to the owner-occupied, they only have to give up 1, and they will have 3 liquid assets or 3 investment properties that they can choose to sell when they need cash straight away. They can also use these properties to do other projects. For example, borrow off one of the property and then use that money to develop another property. Or they can share that security with somebody to do some joint ventures. Whereas you're probably not going to try and do that with your own occupied home. Now, there's a misconception in terms of how the tax works when you do this, because now you're shifting all your mortgage on the owner occupied. But there are certainly some clever ways to structure this mortgage so that you can still get the tax advantage that you should be getting. And a decent mortgage broker will be able to work with your accountant on your behalf to make sure that this happens. And if you have found value so far, please smash the like button for the YouTube algorithm. As a summary, here are 3 arguments to why you shouldn't freehold your own occupied just because you can. First reason is that it's often the last property that you want to sell. So you want to freehold the investment properties that you would potentially liquidate in case of an emergency. Second, it's an asset that gives you very low return because property is about getting that leverage, and a property with no leverage and no cash flow is a very bad place to hold your cash. The third one is you can borrow a lot more money from the bank using an owner-occupied opposed to investment properties, meaning that you'll leave them with less securities and you have more assets in your own control. So if this is a question that you're debating to yourself whether or not to freehold your own occupied, the best thing to do is actually try and put on paper to understand what you are trying to achieve. You also want to know what is your backup plan or your emergency funds or the assets that you would liquidate if you need cash quickly. By doing these thinking on paper, you'll be able to prioritize how you should structure your loan. But of course, you don't have to do this alone. You can use a mortgage advisor, and Mortgage HQ, we do this on a regular basis. So feel free to reach out, support@mhq.co.nz, and talk to one of our advisors and make a plan. Before I leave, don't forget to smash the like button for the YouTube algorithm, and I'll see you guys in the next video.